Good morning, and thank you very much for having me on your show. Yes, Velotrade is an online platform which allows investors to trade and invest in trade finance assets, thus offering cash flow solutions to corporates. So mainly institutional investors, whether they are hedge funds, asset managers, family offices, high net worth individuals and so on, are able to purchase assets that are short-dated, have a very attractive risk-return profile, and are uncorrelated with other asset classes. At the same time, corporates in need for trade finance solutions, whether it's invoice financing, invoice discounting, reverse factoring, e-commerce financing, and later on other aspects of trade finance, have access to new pools of liquidity and untapped capital. Well, indeed, the point is that corporates come to us, we assess them, we assess the trade finance transaction. I think in this we're quite unique because we're able to conduct a very thorough and detailed analysis of the commercial relationship between supplier and debtor, which is something that traditional financial institutions are not really capable of doing. And then we interact, as you said, with other financial institutions that are looking to access a new asset class. I mean, trade finance has been a monopoly of banks and factoring houses for a very long time, and emergences of platforms like Velotrade creates a bridge and allows investors who would not have any access whatsoever to trade finance to interact almost directly with corporates through the bridge that we offer. Yeah, so just to quote you like a very simple example, we are a digital platform, so we have a global reach through digital marketing, through sales efforts, through partnerships. The SME finds out about Velotrade, they onboard through our portal. It's a very simple and pain-free exercise. It's a matter of hours, if not just days. And we then, as I mentioned, we assess the commercial relationship between supplier and debtor, while traditional financial institutions, they always tend to focus solely on the balance sheet of the supplier. By looking at who the buyer is, the relationship between supplier and buyer, we are able to conduct an assessment that is far more detailed and gives more comfort to the investors that we plug in. So once we've onboarded the supplier, once we've run our assessment, we post a trade finance asset on our platform, and we have a broad range of investors, as I mentioned, institutionals, high net worth individuals, family offices, and so on. They get to see that asset, they get to see some of the analysis we've conducted, they get to see who the supplier is, the buyer is, and then we give them enough information so that they conduct an educated decision and decide whether they want to purchase this asset or not. Once they decide to purchase, the flow of funds goes from the investor directly to the supplier, so the investor has an exposure to an asset that brings an attractive yield, has an attractive risk-return profile, and the supplier gets almost immediate funding. When corporates go to traditional financial institutions, they get a very thorough, lengthy, and often very painful analysis of their financial situation. We do part of that as well because, of course, we're putting capital at risk, so we need to run an assessment on the supplier. But I think we believe strongly actually that there are some other variables that are even more important to allow a fair representation of the underlying risk. So the typical example is a small supplier selling to a very, very large debtor. And so if the two counterparts have been working for a very long time together, to focus only on the balance sheet of the supplier is a very limiting exercise. While looking at previous transactions, looking at the pattern of payment, looking at the pattern of commercial dispute and so on, allows us to reach out to corporates that would be either under the radar of other offers of liquidity or that would be underserved. So of course, if a very small supplier were to come to us with no transactional history, with a moderately small debtor, it would be difficult for us to go ahead with a financing solution. But then again, I think the beauty and the attractiveness of a platform like ours is that we have a very diverse source of funding. So transactions that could not trade with certain investors might be liked by different investors who have different appetite for risk. So of course, our analysis would then push us to offer higher returns where there is more risk, and as you know, there's always a risk return that caters to certain investors. So a transaction that for a bank would be impossible to touch, maybe a fairly aggressive hedge fund would be happy to finance. And I think that's the beauty of alternative sources of finance, because they offer different solutions and often tailor-made solutions. So the investor is somebody who's looking for sort of short-dated exposure. I really cannot think of any alternative financial instrument that is short-dated, has the same type of risk-return profile, and is uncorrelated. So I think the asset per se is extremely exciting and attractive. And in fact, with the opening of trade finance to institutional investors and investors in general with platforms like ours, there's been a very big interest in trade finance instruments. So the investors we deal with can be high net worth individuals who have some excess cash and want to put it to work. It can be a hedge fund that not necessarily trades trade finance assets, but trades, for example, equities, bonds, but they always have a component of their assets under management that are liquid, and they want to enhance the liquidity, the returns on that liquidity. There are also a lot of trade finance dedicated funds emerging, because of course there's a broad appreciation of the attractiveness of trade finance. So we talk to funds who are already investing in trade finance assets, and they use us to originate more assets. It can be a family office, for example, a family office that intends to go ahead with a real estate transaction. They know they have 6 months, a year before completion. They're uncomfortable in tying up their funds in long-term investments. They can come to our platform and, for example, invest in invoices or trade finance instruments that can be 30, 60, 90 days, roll them a couple of times. And so they have a very big pickup on the yield they will be receiving if they were to leave the funds on a current account, and they know that they will get the repayment within their timelines. When the pandemic struck, there was a bit of a standstill as people tried to understand what was happening. Suppliers were forced into lockdown, and investors were generally scared about the developments of markets. That didn't last long, and as suppliers have resumed production, as investors are able to better assess the situation, volumes have picked up and we're close to pre-crisis events. On top of it, central banks have slashed interest rates across the globe, so again, for investors looking for yield, there's really no alternatives. So we are expecting very large volumes from investors on our platform to give us capital to deploy in trade finance solutions. Well, the main challenge we've witnessed, which is to be expected, has been in some cases, some isolated cases, we've had some delays of payment. The reality is that we haven't had any defaults. We're very proud of our risk assessment. We've put a number of risk mitigants in place throughout the building of our platform, which have worked and have proved that trade finance assets are indeed uncorrelated to the general market situation. But yes, we've seen some delays, and the delays are due not necessarily to delinquencies as much as debtors expecting longer payment terms and actually forcing suppliers to accept longer payment terms. Well, for sure there will be a massive increase in financing requests. A lot of corporates need to clean up their balance sheets. A lot of them are strapped for cash. The lockdown and the reduction in demand from debtors across the globe has of course impacted dramatically their cash flow. So we have to be extremely vigilant. We have to make sure we don't lower our guard. But we're there to assist corporates in these tough times. We have, again, investors that are very keen to access the space, and they have excess liquidity. So while we have some degree of flexibility to accommodate delayed payments, the capital that we deploy doesn't come from our balance sheet, but is from our investors. So that limits some of the discussions we're having with suppliers. But it's also true that investors generally don't advance the whole amount of the trade finance asset. So if delays were to occur, there is room to negotiate some extended payments with investors still earning the expected interest rate. So we have challenging times ahead, but I think that, again, as the liquidity pours in, probably regulatory capital requirements of traditional financial institutions will keep on increasing, and having counterparts like Velotrade, who's an alternative source of liquidity with a much faster, a very efficient mean to assess risk and to understand the underlying commercial relationships, gives room for growth of our segment. Thank you very much for having me on your show. Thank you, Stanley and Woody. Bye-bye.
Is it done? So Vito, how was it? How did it go?
It was an interesting interview.
Okay.
I was expecting a set of questions which didn't come, and some questions that I was not expecting came, but it was exciting. I mean, we're going through very tough times, and I think alternative funding is extremely important. One aspect of which I would have liked to have discussed, but I'm sharing with the audience, is that technology, as I mentioned in the interview, allows us to explore and understand better commercial relationships and address new needs of the market. So technology itself is creating new needs, and one glaring example is, for example, e-commerce financing. Technology has created e-commerce financing, and traditional financial institutions are enabled to deal with this new request because the risk metrics are so different from what they're used to using. And Velotrade is flexible. We have a very strong tech team, and we're able to partner with suppliers. We're able to access their marketplace portals and get data that allows us to mitigate risk, and therefore offer very fast and tailor-made financing solution. I mean, this is just an example of how markets are evolving. So alternative sources of funding are, I think, a very interesting space to be, and the evolution ahead is going to be very exciting.
Okay, Vittorio, thank you, and let's see what happens next. Maybe we're going to do more of this. Thanks for...
Hope to see you soon.
Thank you, guys.
Bye-bye.
Bye-bye.